Well, we've spent most of our time this year focusing on dynamic aggressive growth, and so far the discussion in part one of this seminar was about dynamic aggressive growth. We actually leveraged the logic and work involved into launching two other dynamic portfolios at the same time we launched DAG. We like the blend of DAG with our Bond Encore for most clients, which we'll discuss in part three of this seminar. But we also had requests after we introduced DAG from other advisors to create a single dynamic portfolio that can be owned in one account for clients that have a lower account value, are seeking a lower fee, or simply like the dynamic asset allocation concept. It's also a good transition for those advisors that are used to the commission type products and want to transition over to a more active approach to asset allocation, which, as we've learned from experience, is far superior in terms of alpha than just that static strategic type passive portfolios. So let's look briefly at our three portfolios. First off is our dynamic aggressive growth portfolio. Now DAG, as we like to call it, is vastly different than any of our past program offerings. As mentioned earlier, it has been years in the making and utilizes the leading economic indicators that we've been following for quite some time. And it really has a relatively simple asset allocation matrix based on the state of the current economy. We start with the Morningstar Aggressive Allocation Portfolio, which is an example of a strategic portfolio. From there, we will overweight or underweight the asset classes based on the economic direction, even including bonds during weak economic environments to offset some of the losses that tend to occur during recessions. So during a bullish period, you could see we're going to be heavy in emerging markets, small caps, and the S&P 500 position, which is always a core of our portfolio. During those neutral times, what's really interesting is you will start to see not only do we lower our allocation to small cap and emerging markets, sometimes eliminating it completely, but we'll also include bonds and a market neutral fund, because at these points, you really don't know which direction the market or the economy is going to go. And then finally, you see our bearish one that will include a pretty sizable chunk to bonds. Now, overall, you will notice that our asset allocation historically has averaged close to the benchmark allocation, which gives us consistent market exposure. This is something we've lacked for the last 25 years. And during these market cycles where you get into a prolonged bull market, that's when you see too many clients leaving risk management strategies, moving into something that has participated more heavily in the market. However, unlike the passive or strategic allocations that we see too many clients moving to, we actually have a logical way to add alpha to the portfolio by increasing that small cap and emerging market exposure or eliminating it completely if the situation dictates. In other words, we're not going to just sit back and rebalance a portfolio each quarter back to that same allocation as we see too many advisors doing, and then still collecting a fee on it. We're going to adjust it based on the market and economic environment. Now, while these portfolios are vastly different than anything SEM has done in the past, there is one thing that they all share with our other programs. They're not based on our opinion, but rather on hard and fast rules that dictate the asset allocation decision. So that's dynamic aggressive growth. Now let's look at one of our other new offerings. Dynamic income allocation, or DIA, is really a different take on income compared to our very popular tactical bond or income allocator approach. Like dynamic aggressive, we use an econometric model to assess the overall economic environment and then adjust accordingly. The benchmark for DIA is the Morningstar Aggressive Allocation Portfolio, which is another example of a strategic portfolio, this time for conservative investors. From there, we will overweight or underweight various fixed income asset classes based on the economic direction and trend in the bond market. Historically, the asset class allocation has been close to that Morningstar Preservation benchmark, which gives us that consistent fixed income exposure. But there's one key difference that you can see there in those pie charts. Rather than using cash, we can go short treasury bonds. In other words, we can make money if long-term treasury bonds lose value, which is what happens in a rising rate environment. Also, the use of dividend stocks gives us some potential upside in what can be a volatile and difficult bond market ahead. You just look where interest rates are. We've argued for quite some time, if we follow the Japan model, they can go lower. However, looking at where the aggregate bond index has been, it's been in a 40-year bull market. We wanted a different way to make money in the fixed income market. Now, from a return and risk standpoint, DIA has far more potential return than other standalone past fixed income allocations. It also has slightly more potential return, but also more risk than our tactical bond or income allocator programs. Remember, this is only going to trade once a month. It's going to be based more on economic growth and isn't going to have that micro focus that tactical bond and, to a little bit lesser extent, income allocator has. However, the return versus risk relationship is still the same. They both have a very high Sharpe ratio, return versus drawdown, return versus modified value at risk. It's all the same, but the key is it's different. It's a different way to make money. The return distributions are so different that a combination of bond encore and dynamic income allocation might be an advantageous direction for some of those conservative investors to go, especially if we get into another time where we see the spread between high yield bonds and treasury bonds contract to a level where it becomes difficult to make money in the high yield bond market on a tactical basis. So that becomes really important. From just a subjective opinion right now, we're still sitting pretty nice as far as high yield bonds go, so tactical bond is attractive. But there is a place that dynamic income allocation can play in a portfolio, especially for those coming over from maybe a more passive fixed income approach where they need higher income. Now let's look at what is probably my most exciting output so far from my CFA studies. It's called Dynamic Asset Allocator. Earlier this spring, we were preparing to launch DAG and DIA, and I came across a reading in the CFA materials that really got my mind working. In fact, I got very distracted, much to my wife's chagrin, and just kind of put down my books and was on the computer, and she said, "What are you doing? I thought you had reading to do." I said, "I just want to check something." Now, this reading was related to the use of derivatives and how they can be used to enhance returns in a portfolio. Now, while we don't use derivatives at SEM, we often utilize funds that use derivatives to provide leverage to a particular index. Some of those that say, enhanced portfolio or leverage, or sometimes you just see 2x funds. Those are examples of it. I'm not going to name specific ones on this seminar. But back to the reading. It suggested that you use derivatives to gain a target exposure and then offset it with a core fixed income portfolio to lower the overall risk and provide enhanced returns. So I decided to just make a simple change to the allocation matrix we were already using for DAG in a couple of ways. First, I decided to use 2x leverage on all the bullish signals. So if it said we were normally in the S&P 500, instead of being in a normal low-cost index fund, we would use this 2x S&P 500 fund, as well as with small cap and emerging market. But the key difference is we would also include 2x negative leverage on the bearish signals for small cap and emerging markets. In other words, if small caps or emerging markets were at a state where the economic environment said they may lose value, we go ahead and we're short those indexes, offset by our long position in the large cap index. Now, to offset the volatility, we only have 60% of dynamic asset allocator invested in this equity allocation model. The other position is offset by some of our core bond fund holdings that also may show up in DIA, which represents the other 40%. Now, this leads to a highly sophisticated asset allocation that evolves over the economic cycle. I tried to put together some examples of 9 states we may be in. There may be other moving pieces in there based on what our income allocation portfolios are doing, that you could see an even more diverse selection. But as you can see, our asset allocation cycle will evolve over that economic cycle. Now, don't be misled by this chart during the bearish times. You can see I know somebody commented and said, holy cow, 120% during a bearish bias. What the heck's going on there? But if you notice, the bulk of those investments are in government bonds in the aggregate bond index, which tend to perform very well during recessionary or slowing growth environments. So the overall results, this is why I'm so excited. It is truly an alternative way to handle asset allocation. It applies to one of the most fascinating CFA concepts that I came across, where you use derivatives, and in this case for us, derivative-based mutual funds, which, by the way, these funds have been around for quite some time. We've used the one fund since 1998 when I started with strategic equity, and they do a better job tracking than nearly all index funds out there. So don't be alarmed by the use of leverage or derivatives in these funds. They have a very strong risk management strategy to make sure they're doing what they're supposed to be doing. But it's just an alternative asset allocation. The return to risk profile is very attractive for a moderate client, but the overall correlation to the market, as well as to our existing SEM programs, whether it's our traditional tactical programs or even our new dynamic portfolios, makes this quite attractive. Unlike DIA and DAG, this portfolio will not have much tax efficiency. So that's one thing that it does have working against it. Obviously, if we're using that many asset classes that use leverage, and we are trading into this many different states, it's not going to be as tax efficient, but it will still have some in there. But this is something, regardless of that concern, I would encourage clients to consider for a 10 to 30% allocation to their portfolio, which is typically the recommended allocation to what we call alternative assets. So we're going to take a bit of a break here, but come back, and next we're going to turn our focus to the real question, which is how to find an overall portfolio. We'll see you in part 3.